Introduction to SRP. SRP is the most comprehensive and trusted source of structured products data and market intelligence. With a global database of 45 million products, our data solutions uncover insights into market structure, sales volumes, key trends, and competitor activity. The choice of leading investment banks, hedge funds, product issuers and distributors, exchanges and asset managers, SRP provides everything you need to understand and stay ahead of the market, with regular updates, data-driven analysis, and access to our special reports covering the latest trends in the structured products industry. SRP data can be accessed from our product search and analysis portal or by integrating our API with your own infrastructure. Welcome to Connected Intelligence.
Hello and welcome everyone to another episode of the SRP webinar series. Today we're going to go through the global market overview my colleague Nico delivered at the SRP Europe conference last week in London. The agenda for today's webinar will look at market trends including sales volumes, most popular payoffs, and shifts in demand on underlyings and asset classes. The first few slides will cover the global market and then we will move the focus to Euro. Okay. So let's get started. The outstanding volume or the money invested in structured products over the last 6 years globally stood at US 2.23 trillion as of December 2024, marking the fourth consecutive year of growth. The increase is attributed to strong activity in the capital protected segment and the rebound of yield enhancement, with significant growth in Europe, 14.5%, and the Americas with 10%. Let's have a look at the regional market expansion and product trends. This chart shows a steady growth in sales across all regions, and we can also see that capital protection remains very strong, particularly in Europe and APAC, with auto-call products experiencing significant global growth across markets. Nico, what other trends did we see in 2024 in terms of issuance and sales?
Thanks, Pablo. Hi, everyone. So the chart shows two key insights here. First off, we see the overall market expansion. Each region has shown steady growth in sales. The Americas was up 31%, the EMEA was up 28%, and APAC plus 14%. And then secondly, the chart highlights a clear preference for yield enhancement products, especially auto-callables, while capital protection remains a strong theme, particularly in the EMEA and the APAC. So from a product perspective, auto-callables have seen the biggest growth worldwide, with all regions seeing expansion, plus 56% sales increase in the Americas, plus 50% in the EMEA, and only 10% in the APAC. We can remember issues with snowball auto-calls in South Korea back in 2023. Now, auto-callable yield enhancement has been growing in the Americas, with some mixed trends in the EMEA and the APAC. Capital protection-wise, Europe shows strong demand for interest rate-linked capital protected structures, up 39%, and the APAC leads in growth for capital protection linked to equities, up 29%. Participation products have rebounded strongly in the Americas, plus 40%, and with more limited growth in the EMEA and the APAC.
Thank you, Nico. Let's have a look at asset classes. And in this slide, we can see that from an asset class perspective, equity share baskets have expanded, whereas single index products have declined. We can also see that single shares experience a moderate expansion across regions, with America rising from 9% to 14%. On the other hand, we can see that single index products have seen a significant decline, particularly in Europe, which they're down to 21% from 37%. While baskets of indices have increased to 24% in the America. What else can we see here, Nico? Can you explain these charts a bit further?
Yeah, so I completely agree with you, Pablo. That's the key insight here. In 2024, we continued to observe demand for stocks and stock baskets linked products and some decline on the side of index linked products. One reason for this less demand for indices could be explained with the high levels of the stock market, of course, and a caution whether this growth was sustainable given economic slowdown risks. And this is why investors have been turning to stocks, especially quality stocks and baskets of such stocks, rather than less concentrated indices. let's take a look at the chart on the right. So share baskets saw the largest expansion in the APAC, making it the most dominant category in the region. EMEA also saw strong growth, increasing from 25 to 33% over the same period. Single stocks, as you said, experienced moderate expansion across the regions, with the Americas rising from 9 to 14, while the EMEA and the APAC have been rather stable. Products linked to a single index saw notable decline across all regions, particularly in the EMEA, when it dropped from 37 to 21%. However, index combination in baskets have played a role in the Americas region. This made them one of the leading product types there, with 24% market share of the offer. Finally, products linked to interest rates continue to be favored in Europe at 15%, while their exposure in the Americas declined for 14 to 10%, and in the APAC, it remained relatively low at 5%.
Thank you, Nico. That's very interesting to see the dynamics between, the different asset classes over time and how the impact of interest rates and other aspects, have an impact on the use of asset classes by the market. Let's have a look at payoff types, the structures being used to deliver these products. Here in this chart, we can see that auto calls, reverse convertibles, and callable structures have grown across the board. And from a market sector perspective, small caps and tech stocks are clearly winning on the winning side with increased market share across all of these payoff types. What else would you highlight from these charts, Nico?
So regarding the payoffs, overall the biggest growth comes from auto calls and callable products. Participation products like calls, call spreads, and digital payoffs have decreased globally. On the underlying side, data suggests a move towards stock picking. So to be more specific, the S&P 500, so its market share has declined from 18% in 2022 to 12% in 2024. And Euro Stoxx 50 has dropped from 10% to 6%, which suggests a shift away from broad market indices. On the other hand, the Russell 2000 has gained traction, especially in the first half of the year, as its market share rose from 5 to 7%. This has been like a bet on rate cuts, which would have benefited the outperformance of small caps. Tech stocks remain key, but preferences are also shifting. So while the Nasdaq 100 remains stable at 4%, individual tech names like Nvidia have doubled in exposure to 4% in 2024, which highlights strong demand for AI-driven growth stocks. Companies like Tesla, Amazon, AMD, and Microsoft have maintained steady or slightly increasing allocations. And it's important to note here that these payoffs, features, and underlyings aren't just used individually. They often appear in multiple combinations. So the trends we are seeing reflect not just standalone use, but also specific pairings where these payoffs and underlyings are featured.
Interesting. And with this last comment, we finished the global part of the presentation. Let's have a look at market developments specific to Europe. Here we can see that the European market has shown a strong upward trend in terms of issuance and sales as well, from 2020 to 2024, with total sales beating the previous year by far. So we see an increasing growing trajectory over time. What other trends would you highlight on this chart, Nico?
Yeah, that's exactly right, Pablo. And to build on that, we can see how different product categories have contributed to this overall growth. Yield enhancement stood out with a strong 37% year-on-year sales increase. It highlights the necessity of returning to accepting some level of risk to maintain the yield, as the industry has navigated rate cuts. Another reason for this increase is that yield enhancement products have been supported by the very good performance of auto callables, with a lot of products successfully redeemed early. And we'll have a chance to review the overall performance of matured products in the next slide. So for now, let's first wrap up here. Capital protection links to rates also saw solid jump in sales, plus 25%, which indicates a still strong interest to lock in high yields with longer maturities products. On the other hand, some categories have contracted. Capital protection linked to equities decreased by 15% in Europe. which benefited rate-based or yield-oriented products. Participation products without protection declined by 34%, and product with reference entities such as credit-linked notes dropped by 22%. Overall, the data is telling us that yield enhancement and interest rate-linked capital protected structures have driven last year market expansion, while more traditional participation and equity protection solutions have lost ground.
Thank you, Nico. Let's have a look at the history of returns and how products have performed and how much they deliver over time. Can you talk us through these two charts, Nico?
Absolutely. So let's look at the performance of mature products. So for this analysis, we have reviewed more than 72,000 products that mature or expired early throughout the year. On average, those products returned 7.8%. The bar of returns is sorted from products term sheets and doesn't take into account any fees, such as management fees or custody fees. We have the histogram on the left, which shows us a balanced distribution of returns. So the data shows a clear concentration of products that delivered moderate returns, with most of them falling within 6 and 12% range. Negative returns are relatively rare, accounting for only a small portion of the market. About 5% of the products lost value, and an additional 0.5% had just returned invested capital. Among the worst performing products are some linked to stocks and stock baskets, which are obviously more risky. Names like Bayer, Alstom in October, Tesla, Kering are among others, and which performed poorly over the year. There is no stock to be immune to risk, Nevertheless, structured product linked to stocks achieved an average return of 8% in total over the year. On the higher end, we see that 7.3% of matured products achieved returns greater than 15% annualized. The chart, looking at the bubble chart, we can see the relationship between product types, their average annualized returns, and the proportion of the matured notional. On the y-axis, we have the average return for each product type. The size of the bubble represents the proportion of matured notional. And our key takeaway here is that yield enhancement product represented 83% share of the matured notional, and they offered one of the highest average annualized returns at 7.9%. Capital protection products represented 15% of the matured notional, but come with a lower average return of 3.2%, which is expected due to their low risk profile. Non-protected participation products and credit-linked notes have a small market presence, which is 1% each. Yeah.
This is a great slide, Nico, because I think it clearly shows that structured products deliver somehow and they add value to investors. So I think it's important to kind of provide a bit of insight into this kind of aspect of the market. Let's have a look at product types in Europe. And I think this is also a very interesting slide because it shows the different pictures you get when you include Switzerland or you exclude Switzerland from any analysis in Europe. Here we can see clearly that yield enhancement in general has recovered momentum on the back of the rate cuts, as you say in the slide, and this is a trend that we've seen over the last couple of years. Can you elaborate a little bit more, Nico, on this one?
Yeah, so I think that's a useful perspective for all of us to factor in the influence of the Swiss market in the broader European trends. Switzerland is the largest market in Europe and one with a strong yield enhancement heavy bias. By comparing the figures that exclude Switzerland, we can tell which product categories are predominantly driven by Swiss market and which trends are consistent across the rest of Europe. So the main takeaway here is the return of popularity for yield enhancement, which has climbed from 55% market share in 2023 to 65% in 2024. But once you remove the Swiss yield enhancement bias, other European markets lean more toward capital protected structures, especially those that are linked to rates. You can see that they represent a quarter of the offer, growing even more in popularity than in 2023.
Yeah, and let's have a look at payoff types in Europe. I think this is also a very interesting one because it shows the difference between Europe, including Switzerland, and excluding Switzerland. Clearly, on this chart, we can see the auto callables dominate the overall picture, with the callables also showing strong year-on-year growth. I think it's clear from this slide as well that that Switzerland is the largest market in Europe, and how the trends in Switzerland can impact any analysis on a broader European trend. Can you explain a little bit more the payoff landscape when you look at Europe, including and excluding Switzerland from the analysis, Nico?
Yeah, right. So we have followed the same protocol here. We're comparing two data sets with and without Switzerland to have to be able to spot any movements in the broad European market. So to start with, as we said, Swiss market has a strong bias towards income-focused products, such as income auto-callables and callable reverse convertible. And as you can see, it raises the overall market share of these categories when Switzerland is included. When we take out Switzerland, we observe a more balanced picture across the rest of Europe, which reveals different preferences, particularly for growth auto-call, so the so-called TINA structures, and callable fixed income structures. Our takeaway here is a clear preference for income-generating products. Auto-callables, they dominate overall with income auto-call and growth auto-call. They maintain strong market shares across the regions. We're going to zoom in on that in a minute. Protected digital and participation-based structures like calls, call spreads face more notable declines.
Excellent. And let's have a look at the regional market shares and the product mix by country. I think this is also a very interesting slide because it kind of gives you insight on how different each market in Europe is from each other, and what the preferences of investors are in the different markets. For instance, if you can look at the UK market, is dominated by growth autocalls, but in Germany, the preference or income autocalls have a significant share of the market. Income products such as autocalls, reverse convertible, and Phoenix memory notes seem to be very popular in Switzerland, Germany, and Italy, but not in other countries. What other trends and interesting aspects would you highlight from this breakdown, Nico?
Yeah, so for the autocallable products, we can also see protected autocalls last year, products that offer capital protection alongside the coupon. These were popular in markets like France, 10% part of the offering, Poland, 11%, and to some extent in the UK, where they present 7% share of the offer. In France, notably, there was considerable traction in bearish autocallable products that are betting on cuts on the 10-year interest rates. So we have the 10-year CMS and also the French 10-year constant maturity rate, the TEC 10. This was a new structure for the market in 2024, and that has been driving the activity, especially in the second half of the year. Callable fixed income is by far the dominant product in Belgium with 55%, which together with notable steepener shares, 32, highlights a focus on interest rate linked structures in Belgium. Protected digitals leads in Italy, 33%, and is also significant in Ireland and Poland. Credit-linked notes stand out in the Nordics with Finland and Sweden, each having 15% credit-linked notes out of the offer.
Yeah, let's have a deeper look into the asset class trends in Europe. And I think in this chart I can see that stocks and baskets of stocks have increased the market share, and it seems to be driven by the Swiss market activity. However, there has been a bit of a decline in the use of index-linked products, and on the other hand, an increase of interest rate-based products, which shows that interest rates remain quite strong, retain the momentum in the market. What else can you tell us, Nico?
That's exactly it, Pablo. The boost in stocks this year was also increased by the growth in the Swiss market. So giving a bit of perspective, the data shows index-linked sales volumes falling to 24% of the offer in 2024, down from 30% in 2023, and down from 47% in 2020, which was a steady decline over the years. The share of interest rate-based products continued to rise, reaching 16% in 2024, up from 14% in 2023. Less popular asset classes like forex rates, credit funds, and commodities maintained smaller, though stable share in 2024, which was consistent with 2023.
Excellent. Let's go and look a little bit deeper into the underlying types used in Europe. I think this is also a very interesting one because, as we said, there's been a decrease in the use of index-linked products overall, but there are specific areas of the index-linked products type that is still driving quite a lot of traction and demand and activity. One of them is the decrement indices, which alongside interest rate linked products really clearly stand out on this chart. Another thing I can see here is that thematic indices, including artificial intelligence, digital transformation on consumer discretionary sectors, have also shown significant growth. What else would you highlight from this breakdown, Nico?
Right. So both data sets show a decline in benchmark index-linked products, with Europe ex Switzerland dropping from 18 to 14%, and Switzerland from 8 to 6%. Sector benchmarks have also seen a 1% decrease. Outside Switzerland, which is the chart on the left, there has been some recovered interest in decrement underlyings. We can see separately the percentage-based decrement indices, which increased from 6% to 8%, while decrements deducting points edged to 5% market share. Outside of Switzerland, we've seen a notable increase in rates-linked products up from 18 to 24%, while Switzerland saw a slight decrease from 3 to 2%. Forex rates saw a rise in Switzerland from 5 to 7%, while Europe ex Switzerland saw a decline. And finally, commodities had a small decrease in Switzerland from 2 to 1% market share.
Excellent. And let's have a look at the underlying mix breakdown by country. Another very interesting slide that shows clearly how different the European markets can be. Here, again, the preferences varied depending on what market you are. What would you highlight, Nico, from this chart?
Right. To summarize the key insights here, so we have benchmark indices dominating the UK, Ireland, and Germany. Decrement indices are strongest in France and Germany. In France, we saw interest in static thematic baskets with a decrement. In Italy, high dividend yield indices represent 5%, while risk control indices have a small presence in Ireland and Poland, around 5%. These remain niche underlyings in the broader markets. Single stock and worst of structures are more common in Germany, Italy, and Poland. Interest rate products have a dominant share in Belgium, but are so popular in France. Credit link products remain niche, mainly in the Nordics, and small share in Italy, of the order of 4%.
Yeah, and let's have a look specific to decrement underlyings, also known as synthetic dividend indices, which have become one of the most popular underlyings in Europe, in terms of a thematic or custom type of exposure. Here we can see that the issuance and sales linked to these decrement indices have evolved, or how they have evolved over time. And since they were introduced to the market just before the COVID pandemic, what would you highlight from this chart, Nico?
Right. So on the right hand side, we see decrement underlying market shares out of the index-linked universe. We have taken out Switzerland, where decrements had no presence because the short maturity of the products in Switzerland make decrement indices not popular because they actually there's not rationale to use them with short maturities. So the percentage-based decrement indices have been recovering as they increased market share to 90% from 15% in 2023. This category peaked in 2021 at 27% in the index universe, but it declined subsequently in 2022-2023 before now bouncing back in 2024, 19% as we saw. Fixed point decrement indices have been stable at 12%, which is unchanged from 2023. This category saw growth from 6% in 2019 to 13% in 2021, and now it's stabilizing around 10-12% in recent years. We have also included here the stocks with decrement. How do we would normally consider them in the stocks category? Still, it is interesting to see that they nearly doubled from 5% to 9% in 2024. These underlyings are popular in markets again with longer maturities, and France remains by far the main market for decrement indices due to its bias towards long-term structures in life insurance, for which these indices are more suitable. Beyond France, decrement indices replicating a single share, single stock, have been increasingly used in Finland.
Brilliant. Let's move on to the next slide, and I think this is also a very interesting one because it's pretty specific to Europe, where the ESG underlyings have been used for many years now, and obviously the current geopolitical environment is not helping to kind of drive ESG forward. And it seems to be, the whole market or the whole ESG activity is facing a time of reckoning. And it seems to be at a crossroads, but there's still quite a lot of activity in Europe. And as we can see in this chart, what would you highlight from this, from the activity we've seen on ESG in Europe, Nico?
Yeah, I think that's a crucial perspective here. So you can see sales volumes on the left. ESG index-linked products still raised around $14 billion US dollars in 2024, which was a recovery from 2023's dip. On the other hand, ESG products are up as green social bonds have been flat in a growing market, which marks a downward trend for their peak in 2022. On the right-hand side, we have ESG market share within the index-linked offering. So index-linked products edge up only 1.5% within the index-linked space. Their market share increased from 21% in 2023 to 22.5% in 2024. So, however, when we look at their share out of the total offering, they have slightly declined from 6 to 5.5%, which indicates here that while they remain relevant within the index-linked structures, their overall presence in the market has softened. Green social wrappers, on the other hand, dropped to 1.8% of index-linked products and 0.7% out of the total offer. So our takeaway here is that while ESG-linked products remain a key component within index-linked offerings, their broader market penetration has seen a slight pullback in 2024.
Excellent. And let's have a look now go deeper into the ESG thematic and look at what kind of components we see on those ESG indices and which markets are actually driving the ESG activity. Obviously, as we can see on the right-hand side, France is clearly dominated. But Nico, can you just talk us through these two charts?
All right. So, and to build on that, we managed to define a few recurrent high-level ESG thematics. Even though we can see a clear dominance of indices with a broad ESG screening, whether ESG integration through best-in-class or ESG exclusion strategies. In terms of sales volumes, these account for 38% of the ESG-linked products. Climate-focused strategies remain significant at 16%, while Paris-aligned benchmarks stand at 14%. Then we have sustainable development goals, which also hold a notable share at 11%, and more specific ESG thematics such as biodiversity, water, energy transition, each make up 2% or less, which indicates that while they are gaining traction, they remain relatively niche. On the market side, France is by far the dominant ESG market, accounting for 3/4 of the market, and is followed by Germany at 21%. Other markets, including Italy, remain relatively small in comparison. So overall, the data highlights a stronghold of broad ESG and climate-related strategies, with France leading the way as the key markets for ESG investments.
Excellent. And let's just, we're reaching the end of the presentation. This is the last slide. And here we can see index thematic trends. As we mentioned before during the presentation, index linked structures have gone down relative to stocks, single stocks and baskets of stocks products, but still retain quite a lot of weight in the overall market. And we can see clear trends here in the sense of there's been a shift towards artificial intelligence. There's clearly a lot of activity around digital transformation. On the consumer-driven sectors is also something that is driving a lot of activity in terms of thematic trends. Energy sectors have retained their visibility in the market, driving significant issuance and sales, with financials also being the biggest thematic with a 39% market share. What else would you point at in these two charts, Nico?
We are looking here at the shady section of the left-hand side, which has been driving activity within the index-linked space, along with ESG thematics and regional-based focus indices. The heat map on the right-hand side provides a breakdown of which investment thematics have performed in 2024 in terms of year-on-year sales growth, market share, and shifts in positioning. The standout performance is artificial intelligence and robotics with 326% year-on-year sales growth, the highest among all sectors, and a 7% market shares out of the thematic segment. So this sector is becoming a key driver of innovation. Another major growth is digital transformation, specifically the exposure to digital security sector with 245% year-on-year sales growth. Currently, this sector holds 3% market share in the thematics outside ESG. The broad consumer discretionary sector has experienced a big 188% year-on-year sales growth. The auto manufacturer industry is ranking fourth, is also seen an increase with 60% year-on-year sales increase. The interest in semiconductors surged exponentially in 2023, so last year has only added a moderate 20% year-on-year growth in the exposure to the semiconductor thematic, but the trend continues, especially now that semi-stocks have been caught up in the broader sell-off in technology recently. Luxury goods, so minimal growth, 2%, maintaining a 5% market share. And among the declining, we see sector-based thematics. Financial stocks have been traditionally one of the largest sector exposure for structured products, 39% market share outside of Switzerland. And we can see it losing market share because of the now popular high growth or innovation-driven thematics as AI, robotics, digital security, and so forth.
Yeah, thank you very much for the insights, Nico. This has been a very interesting presentation. Okay, so here's a few takeaways that I will put forward from this market analysis. One is that the outstanding volume linked to structured products has posted for the fourth consecutive year growth globally. We see that capital protection remains very strong, particularly in Europe and in APAC, with core products also experiencing significant growth across all markets. In Europe, specifically, demand for single stocks and baskets of stocks has increased, driven by the growth in the Swiss markets, as we've mentioned, and the use of thematic indices, also including artificial intelligence, digital transformation, and other sector indices, has also posted significant growth. And this is the end of the global overview. If any of you wants to access a digital copy of the presentation, it will be available for downloading on the SRP website. If you have want to access any of our insights or want to check with us or have any queries about our data, please give us a call or send us an email. And there's also, I believe, a QR code at the end of the presentation, which can be used to book a custom demo. So please feel free to reach out and we will be happy to help. Thank you everyone again for your attention and see you next time. Goodbye.